Just before we begin, just to remind everyone, we do have a call for papers, and the deadline is June 26th, and we're very much looking forward to the new submissions. And for today, we're very pleased to have Claudia Moise, who will talk to us about circuit breakers, liquidity, and the COVID-19 crisis. Claudia has asked that you keep your questions until like 15-30-minute marks. If there are any burning questions, please put them in the chat, and I may or may not interrupt Claudia, depending on how burning that question is, or if you're afraid to forget your question, also please feel free to put it in the chat. However, Claudia will not be able to monitor the chat until probably the 15-30-minute mark, but I'll be looking at it and checking on the questions. With that, Claudia, the floor is all yours. Thank you very much.
Thank you very much, Katya, and thank you very much to all the organizers for including my paper in this prestigious seminar series. So in this paper, I explored the performance of the current stock level circuit breakers that are operational in the US and their interaction with market dynamics during times of market stress, such as the COVID pandemic. So a bit on the background. The single stock circuit breakers got implemented in response to the flash crash of May 6, 2010, when financial markets experienced large price moves caused by temporary liquidity gaps, which could not be addressed by the existing mechanism, the market-wide circuit breaker. So to guard against the potentially harmful effect of extreme volatility and to promote stability in the financial markets, regulators have implemented the single stock circuit breakers. The ones that we are looking at are the ones implemented under the Limit Up, Limit Down, LULD, National Market System Plan to address extraordinary market volatility. The implementation started in 2013-2014. The plan was approved on a permanent basis in April 2019. And the important thing to keep in mind is that circuit breakers under LULD are triggered by activity in quoted prices, not by trades. So the idea is not to have to break these trades after they occur, because that will increase uncertainty in the market. Now, rare events such as the COVID-19 crisis provide us with a unique opportunity to stress test the circuit breakers. So the COVID crisis was characterized by extreme volatility. And basically, the crisis gave us an opportunity to examine the performance of the circuit breakers and to also to assess the extent to which they interact with market dynamics during times of market stress of the type that has motivated the introduction in the first place. So extreme volatility is important, can cause systemic risk, and is important both from an investment and a regulatory perspective to find whether circuit breakers operate as designed, and also to assess the effect on market quality and trading activity. Now, the existing literature that we have mostly covers non-US mechanisms and also earlier data. And it provides us with conflicting results regarding the benefits of having circuit breakers in place. So the contribution of this paper is the following. First, I identify the economic triggers for the recent circuit breakers. I estimate their effect on market quality and their trading interference, which leads to market fragmentation during times of market stress. I also document the externality they inadvertently create on the derivatives market. And by looking at some of these inefficiencies and discussing refinements to the existing mechanism, the paper has immediate policy implications for the ongoing debate on the design of the US market structure and the related regulation. Now, to understand the circuit breaker mechanism, I will start by covering institutional details. The LULD plan prevents trades from occurring outside specified price bands called price limits called price bands, which are set as a percentage level above and below a dynamic reference price. Now, the reference price itself is a 5-minute average of transaction prices, except for periods following openings and reopenings. And it gets updated with the pro forma reference price every time it deviates at least 1% from it. It has to be in place for at least 30 seconds. Meanwhile, the pro forma reference price gets continuously updated during the day as a 5-minute arithmetic average of the previous trade price. So I will show you a graphical example to see how this works. Now the price bands, the price bands for the are set up for two groups of securities. There is a group of securities called Tier 1. These are large securities, constituents of S&P 500, Russell 1000, and some high volume ETPs. And then we have, and then we have Tier 2, the rest of the market. These are smaller securities. And we can see here that these price bands are first tier specific, but also within tier, they are price level specific. Now, what you see on this slide are two versions of the plan. So there is the original plan, and there is the newer version implemented under Amendment 18 on February 24th, 2020, exactly during the pandemic. And you can see that for smaller securities, there are larger price bands, basically to accommodate trading characteristics in these securities. And also during the open and close, the price bands are doubled. So the idea is that during the open, we know that there is high volatility because overnight news get incorporated into prices. During the close, market makers are closing the book. So we had these double bands at the open and close. Now, under the newer version, the main difference is that the double bands, the double bands during the open got removed. So basically you have only double bands during the close. I'm sorry, I'm trying to move okay, good. So so the double bands during the open got removed. And also for larger, for the higher price tier 2 stocks, also the bands got changed. So the open represents the first 15 minutes of the trading day, the close the last 25 minutes of the trading day. Okay, good. Now, the LULD introduces the novel concept of a limit state. So the limit state occurs when there is one side of the market for a security that is outside of the applicable price band. The limit state can last for no more than 15 seconds, and its purpose is to keep momentary gaps in liquidity from causing a rapid and large price change. Now, if the limit state lasts 15 seconds, then the limit state is followed by a trading pause. The trading pause will last for 5 minutes and would be followed by a reopening auction. The purpose of the trading pause is to facilitate fundamental price moves. Now, we can have, and actually we did have a lot of repeated trading pauses during the sample period. And finally, we have the straddle state when one quote is outside the price bands and the stock is not in a limit state. And there is no limit on how long it can last. The straddle state can also end with a halt. Okay. So limit states are designed for momentary gaps in liquidity, and trading pauses are designed to address fundamental price moves. This is the important part to keep in mind. And this is a simulation where you can see the bid and ask in blue and yellow. You can see the trade price in between. You can see the reference price that starts here. The reference price has to stay in place for at least 30 seconds. It updates with the pro forma. The pro forma is the dotted black line. The reference is the red line. So the reference price is a step function. The upper limit and the lower price bands are constructed based on the percentage parameters around the reference price, around the step function. Under the original version of the plan, exactly at 9:45, these price bands were dropped in half. And here you see at this point in time, the stock enters a limit state. If we zoom in on this pink shaded area, you see there's a limit state that for 15 seconds in yellow, and then there is a trading halt for 5 minutes, and then there is a reopening auction. The auction reopen at any price. Okay, good. For the data, so the paper has all the details about the features and the all the cleanup that I did on the data. So I'm just gonna tell you that I use the 9 nanosecond timestamp data from Daily Talk and Daily Talk quote LULD. I use daily data from SEC's MIDA system, which is sourced from the consolidated tape. I use weekly data from FINRA ATS alternative trading systems over the period January-April 2020. Now some statistics. So you can see that tier 1 securities, these are larger securities. They are more liquid, less volatile compared to tier 2, the smaller group of securities. Now, because the price bands are tier group specific, I'm reporting the events, the straddle states, non-executable limit up and limit down events by a tier group. Now, because of proximity of these events, where we can have straddle states followed by straddle states and further other straddle states, I collapse all the events in a specific security in one event, one observation for that day. So here I report, for instance, the number of security days with straddle states on the first row. And also I report the percentage of days when there were such events recorded. And you can see that tier 2 experience these events every single day throughout the sample period. There are more events in a tier 2 compared to tier 1. And just for comparison purposes, I'm showing you what happened during the 4th month prior to the sample period. So, for instance, you can see in tier 1 from 532 straddle states, we get to almost 7,000 straddle states. From 15,000 tier 2 straddle states, we get to around 56,000 during the sample period. So there is a large number during the sample period. Basically, these results show that the price limits are binding. Now, because the amendment 18 removed the double bands during the morning, I'm also looking to see what happens during the open, during the first 15 minutes, and outside of the open, the rest of the day. So although the open represents less than 4% of the trading day, we see there is a disproportionate number of events during that time compared to the rest of the day. And the numbers get much larger after February 24th, when the double bands during the open got removed. Okay, good. Here I'm just showing you the time series dynamics in these numbers. So basically, you can see that the numbers started to accumulate after February 24th. So in the second part, when the new version of the plan was in place, and this is valid for straddle states, limit up and limit down for both tiers. So the top row presents results for tier 1, and the bottom row presents results for tier 2. Good. Now I'm focusing on the trading halts. Now what I do is the following. I exclude halts that occurred in the last 10 minutes of the trading day, because in this scenario, trading will not reopen. So instead, the primary listing exchange will execute a closing transaction based on established procedures. And I do need transaction prices after the trading halt in order to determine the economic triggers for the trading halt. I also exclude halts that do not qualify as LULD pauses, halts that are not preceded by a limit or limit states or straddle states. So for instance, if there was an equipment changeover or sub-penny halts. I also isolate the effect of the LULD from the short sale circuit breakers by removing halts that are triggered per SEC Rule 201. And I disentangled the effect of the single stock circuit breaker from the market-wide circuit breaker, which is a source of crash and potential contagion, by excluding halts triggered by the latter mechanism. Okay, good. So now, in order to determine whether circuit breakers, Katya, any questions that I need to address right now?
So there was a clarifying question from Chester in the chat about the triggers for circuit breakers, and I don't know if other people might have questions as well. So the Chester's question, I'm just going to read it out. I'm not sure if you can see it. I don't understand the point.
You want me to talk, or?
Sure.
Yeah. So, Claudia, perhaps in your initial slide, you said that the circuit breakers are triggered by quotes rather than trades. I just don't understand that. Triggering by trades doesn't mean breaking trades. You suggested that it did.
The halts are triggered by activity in the quoting system, not by trades.
Oh, so it's triggered by. So it's triggered by quotes. It's not triggered by trades.
By quotes, yes.
It's triggered only by quotes.
Compared to the previous.
But it's not the case that if it was triggered by trades, that would mean that the trades would have to be broken. That just may be some choice that the SEC made, but it doesn't have. You could have it triggered by prices and not require breaking trades. Breaking trades, I think, is an offensive notion personally, and I think the SEC really blew it when it started to break trades in some matters.
Right, because that will increase uncertainty in the market. That was the idea, right? If they are broken, yes.
Yeah. But I also had a second. Question. I didn't write that in the chats, but this is at the pause. So my second question is: so what? How So here you obviously you can analyze where they set the parameters, but how does one really get at the issue, the fundamental issue of either whether we should have these parameters in place at all, or maybe a different way to say it is what should these be? At what point should they be? There's so much Monday morning quarterbacking, it seems to me, in this whole space. People look back and then they say, "Oh, this is not a criticism of you, but this is a criticism of the regulator." They look back and they say, "Well, what would have been better? What would have been better triggers?" Well, that would have been better triggers for the past. And just like some of those commercials say, the past doesn't predict the future. I mean, we don't know how much volatility there's going to be in our markets, and where we should set these triggers, and where trade is going to be interfered with, and there's a lot of value to the trading process. So I agree, that if there's a liquidity problem, you'd like to bring more liquidity in, but to close markets down for 5 minutes maybe seems to me a little bit long, etc. And also, I just don't know how to think about the issue of really where to set these things on an ex-ante basis. So I don't know if you have any thoughts about that.
These are excellent points, Justin. So I will show you my results, and you already know my my results. But some of the points that I'm trying to make is that there may be refinements that can be implemented to avoid these trading halts, to avoid having these long interruptions, these 5-minute interruptions, because basically you delay the price discovery process. Yeah.
Okay.
Yeah. So thank you. I think actually I have Claudia and I had worked before COVID on this too. So in her defense, I think the purpose of examining these would also be to see if we go too much in one direction, right? The current bonds, so price continuation versus reversal or magnet effects. So I was wondering, do you have those as hypothesis, or is it just a calibration exercise?
So I will show you the economic triggers. I'm gonna go over the slides, and PK, you can ask the question again if you have other thoughts on top of the exercise that I'm doing.
Yeah. I think now I see the slide. So yeah, those are those look like those are your hypotheses, right? Yeah. Thank you.
Okay. Yeah. Yes. Thank you very much.
Have a clarifying once for the like for the timing, following up on just like this, like hasn't been changed, right? It's always been whatever was designed in 2013, 2014 in terms of seconds and the duration of the hold. Has that ever been reevaluated or any thoughts on?
Yes, there are continuous amendments made to the plan, yes, and continuous refinements. And the one that I'm gonna focus on is the latest version that I'm going to perform my tests on.
And there is a comment from Jim Engel in the chat. I don't know if you want to speak up, Jim, or.
I just wanted to say that I agree with Chester about the arbitrary and ad hoc nature of the way we designed LULD. The basic idea is that when the market mechanism is not producing the correct price, whatever that means, then maybe we should switch to a different market mechanism. So the idea is if a continuous market mechanism is doing something that ex post we would look at it and say, nah, that price wasn't the right price. Well, then switch to a different one like a periodic auction, and that presumably would produce a better price. So that's sort of the whole idea behind trading halts and pauses. But I was just saying that I agree that when they set it up, it was pretty ad hoc of like, well, 5 minutes feels good. And there's really been very little work to optimize this regime switching that we've implemented.
Yes, thank you, Jim. That is our excellent point. Thank you both, Jim and Chester. So to determine whether circuit breakers operate as designed, it is crucial to identify their economic triggers. So the current under the current mechanism, markets trading has been designed to halt in volatile markets caused by informational shocks. However, in practice, after a trading halt, the price can move in the direction it moved before the halt, which will be in line with the plan, or it can revert back to its pre-suspension level. So under the first scenario, when trading resumes after the halt, I expect to see price continuation. And this is a scenario consistent with an asymmetric information hypothesis where fundamental news get permanently incorporated into prices. And in this case, the halt would be a news event. Under the second scenario, when trading resumes after the halt, I would expect to see price reversal. And this is consistent with an inventory control model where dealers rebalance their positions during the halt. And in this case, the halt will be an illiquidity event. Good. So now to identify the economic triggers, we need to go to high frequency price formation. So the observed price, P tilde, has two latent components. One is the fundamental value P, and the other one, the deviation component psi. The fundamental value is the permanent component. It will prevent in frictionless markets, and it reflects the incorporation of fundamental news into prices. It occurs during the price discovery process. The deviation component may be due to the trading demands of uninformed, impatient traders or inventory risk exposure of financial intermediaries. It reflects the existence of frictions in the market and is related to illiquidity. Now, the log fundamental price follows the solution to the stochastic differential equation, where QT captures the jumps. Phi here is a continuous predictable drift process. Spot volatility is a Cadillac, is a right continuous process. W is a standard Brownian motion. QT is a pure jump Levy process, and psi, the deviation process, has zero mean and a finite force moment. And from a market microstructure perspective, it makes sense to allow for a non-zero correlation between the fundamental value and the deviation process. Now, if you divide each day of length h into m subperiods, and if we consider delta h over m, the distance between observations, the fundamental price process follows this continuous stochastic semi-martingale plus jumps. And the jth intraday return will itself have two components, the fundamental return and the deviation return. Now, I follow the literature and assume that the fundamental return has a stochastic order of magnitude big O of square root of delta. This means that over small intervals of time, there is a slow accumulation and processing of information. Meanwhile, the deviation return has a stochastic order of magnitude big O of 1. So basically, this is related to, this is related to the trading mechanism and has a higher stochastic order. So in other words, the deviation process moves at a much higher frequency compared to the fundamental process. Now, the variance of the return, of the observed return, follows a two-variance model. So we have the variance of the fundamental component and the variance of the deviation component. So there is, so there is the variance of the permanent component and the variance of the transitory component. And now, if we think about what the plan is doing, by trying to address extraordinary volatility, the plan tries to keep markets operationally liquid during stress times. So it's concerned with this, with the variance of this transitory component. That's the extraordinary volatility. Okay. Now, as for the halts, the number of securities with one halt per day is smaller than the ones with multiple halts per day. So basically, over this period, securities have mostly multiple halts per day, which is why when I do my my exercise, since these halts are very close in time, I collapse all the halts into one record per day for an individual security. Now, to identify the economic trigger, again, I'm gonna look at the high frequency price formation. So in the absence of news, the fundamental price will follow the diffusion part of the stochastic differential equation. When news arrive, either good or bad, they get recorded in the jump component and they get translated into a price trend. So they get permanently incorporated into prices. Now, any momentary gaps in liquidity will translate into, will be captured by this transitory, this deviation component. So what I do, as I told you, I collapse all the halts, multiple halts in one event, and then I consider two time windows. So one time window is T1. This is the time from open until the halt occurs, and T2 is the time window from when the halt ends and the closing of trading. And what I do, I analyze the price trends in T1 versus T2 to determine whether there is price continuation or price reversal in the second period in T2 compared to T1. Okay. Now, by grouping multiple halts into one daily event for a specific security, together with the transitory nature of the deviation component, means that I actually underestimate the number of illiquidity-driven halts in the presence of fundamental news. So this setup works against detecting the halts caused by momentary liquidity gaps when there are fundamental news in the market. And yet, when I look at the price behavior, I find that in most cases, there is a price reversal. So in Tier 2, 76% of the cases are actually reflect a price reversal. So basically, the halt was illiquidity driven. In Tier 2, 79% of the cases. So practically, the trading halts occur not only to accommodate fundamental price moves as designed by the plan, but they are also, and they are mostly triggered by liquidity gaps. And if I focus only on the S&P 500 constituents, the percentage of price reversal is actually 85%, even higher. Okay, good. And here you can see the time series dynamics in the number of securities with specific halts. So you can see that through time, the liquidity-driven halts have a higher magnitude compared to the news-driven halts. The illiquidity-driven halts are in blue, news-driven halts are in yellow. Tier 1 on the left side, Tier 2 on the right side. Good. Now, because most of the halts occur in the second period, I'm gonna now look at the effect of circuit breakers on market quality, and I'm gonna focus on the second part of the sample. Okay. Now, for market quality, I'm gonna look at price discovery and liquidity. And what I'm doing here, I'm using the regression discontinuity design, RDD, which is a quasi-experimental design that focuses on observation around the threshold to determine the causal effect of a treatment. The threshold event here is when a security enters a limit or a straddle state, and the treatment occurs if the security ends up with a trading halt. The market quality metric, either illiquidity or price efficiency, is captured by YI, which is a daily cross-sectional average. T is captures the treatment. Alpha is the treatment effect. And to increase the precision of the estimates, I use classical controls, average quote volatility and average log volume. And here you can see the number of securities. So one halt on the top row, Tier 1 and Tier 2. Again, you can see most halts happen from February 24th on, multiple halts in the bottom. So this justifies why I'm doing the exercise over this period, so starting from February 24th. So I need to have the treatment in place. For proxies, for illiquidity proxies, I start with the effective spread, which is percentage deviation between the price and the mid-quote. This is normalized by trade direction. I compute an average effective spread for each stock, and then I take the cross-sectional average across all stocks, and this is my metric of interest. Next, to determine whether the halts impose a toll on liquidity provision in terms of adverse selection, I decompose the effective spread into the price impact, which captures, which is a proxy for adverse selection, and realized spread, which captures expected profit, where the average price impact is defined here. So the price impact is the difference between the mid-quote 5 minutes after the trade and previous mid-quote. Also normalized by trade direction. I take a cross-sectional average, realized spread, the difference between price and the mid-quote 5 minutes after the trade, normalized by trade direction. Again, the metric of interest is the average cross-sectional realized spread. Okay, and now if we look at the results, for Tier 1, halts lead to an increase in average effective spread and average realized spread. And for Tier 2, all three metrics are increased. So basically, halts lead to a deterioration in liquidity for both tier groups. So what we saw so far is that halts are mostly triggered by liquidity gaps, and in turn, they are followed by subsequently lower liquidity in the market. So basically, there is an illiquidity feedback effect that is facilitated by trading halts in the market. For price efficiency, I use variance ratios. So if prices were efficient, so basically in efficient markets, these differences should be equal to 0. So these ratios captures the deviation from a random walk scenario. I have for each stock variance ratio, 5 minutes, 15 minutes, and 30 minutes ratio, and then I compute the cross-sectional average of these ratios. And what I see is that for Tier 2, so for the smaller securities, that there is a deterioration in the short term is price discovery due to the trading mechanism that leads to these halts in the market. So now, if we put together all these findings, we can interpret the results as traders' funding constraints leading to a delay in trading and stale prices, especially for Tier 2 securities, which are followed by an exacerbation in order imbalances, as circuit breakers cannot distinguish between their economic triggers. Okay, good. So we see that liquidity I'm sorry, Katya, are there questions that I need to address? I'm past the half of an hour.
Well, I'm not currently in the chat, but if anybody has questions, please raise your hand, maybe. Or maybe raise your hand as Claudia will continue to speak. So I think we can just go for now, and then
Okay.
maybe people would collect it at the end as well.
Okay.
But
Okay,
feel
thank
free
you.
to raise your hand even if you don't have the question urgently.
Okay. Okay, so we see that liquidity goes down after the halt. And the question is, what happens to liquidity? What are the channels through which liquidity gets depleted? So when faced with dwindling liquidity in the market, traders may re-strategize. So for instance, it has been documented that orders get canceled during single stock trading halts. And this may be explained to some extent by liquidity migrating to dark pools. Also, it has been documented that there is an acceleration of trading in the presence of price limits, the so-called magnet effect. And this can be, again, explained to some extent by use of intermarket sweep orders by ISOs, which are immediately eligible for execution. They can be used to access quotes deeper in the LOB outside of best prices. So they offer faster speed execution and the ability to capture larger counterparty depth. And here I show you a graph where I plot the number of security days with halts in blue, and the dark trading activity in yellow as obtained from the FINRA ATS alternative trading system data. And basically what we see here is that days with, or I should say periods with increased number in halts are also characterized by an increased dark trading activity. Now, the FINRA data, the granularity of the FINRA data does not allow me to establish causality because these data are reported on a weekly frequency. So what I do next, I go back to the high frequency data. I build the dark to trade ratio. And I also build an intermarket sweep order use ratio. I take advantage of, again, of the same RDD methodology. My metric of interest now is going to be the average dark trading for the average for each day dark trading activity and average ISO trading. Now, both dark trading and the use of ISOs have been documented to be used by informed traders. So I also include an additional control, the average order imbalance. And what I find is that halts lead to an increase in dark trading in large securities, and also an increase in ISO orders in tier 2 securities. There is actually a decrease in ISO orders usage for tier 1. Okay. So basically the depletion in liquidity in tier 1 securities post-halt can be explained to some extent by liquidity migrating to dark pools for the large securities. Now, in general, dark pools are beneficial to the market because they offer alternative venues for accessing liquidity. However, during times of market stress, they siphon liquidity from the lead markets. As for the ISOs, there's an increased use of ISOs in tier 2 securities. So the post-halt depletion liquidity in tier 2 securities can be explained to some extent by ISO usage. Why is this important? Because it has been argued that an intensive use of ISOs can lead to flash crashes in the market. Also, this table shows that there is fragmentation in the market during times of market stress. Okay, good. Now, for robustness checks, what I do, I address a possible concern that there may be a difference in the treated versus non-treated securities, in that the treated securities that get halted may experience additional negative news that arrive to the market during the halt, which preclude investors from providing liquidity to reverse the limit or straddle state. And to address it, what I do, I refine the group of treated securities by keeping only those securities with illiquidity-driven halts to be most similar to the ones that actually revert trading. And basically, these results only show the treatment effect. Results are even stronger in this case. Good. Now, the next exercise is to look at the effects of the halts in the equity markets on the derivatives market. So here I focus on the SPDR, ticker SPY, which is an ETF that tracks the performance of the S&P 500 index. So what happens is the following. When the constituents of the S&P 500 halt, the ETF continues to trade. And when trading in the S&P 500 constituents resumes, jumps may be recorded in the SPY price to reflect the new value of the underlying. Otherwise, there would be an arbitrage opportunity. So exchange-traded products rely on market makers to arbitrage away any differences between their share price and the value of the underlying. Now, this high-frequency arbitrage mechanism may get disrupted when the constituents of the S&P 500 halt. And this is actually what happened during the mini flash crash of August 24, 2015. So halts may lead to a dislocation between the SPY and the underlying portfolio. And jump risk is also important for risk management and portfolio allocation and the valuation of derivative securities. So what I do next, I look at the relation between halts and jump volatility. So to do this, first I estimate jump volatility. So to do so, I take the difference between the realized fundamental variation, RV, which converges in probability to the quadratic variation, and the bipower variation. And actually, the square root of this difference captures jump volatility, the estimate on the bottom of this slide. And here I show you the time series jump volatility in the SPDR. I also plot the jump volatility during the flash crash to give an idea of the economic magnitude of the one that was recorded during the crisis. The red dots here show the days when also the market-wide circuit breaker got triggered in March 2020. And the test that I'm performing is regressing the daily SPY jump volatility on the LULD events. So here in the first column, we see that the number of halts are positively and significantly associated with SPY jump volatility, explaining 36% of their variation. Now, because the index may jump due to macroeconomic news. What I do, I control also for market uncertainty using the Economic Policy Uncertainty Index, EPU, of Baker, Bloom, and David, and I find that results are robust. And finally, I also control for leg jump variation, and results are robust. So basically, for instance, in this case, we see that a 1 unit increase in the number of halts leads to is associated with a 0.48% jump volatility in the SPDR. Now, some of these halts may be news driven, and they are absolutely motivated. So what I do next, I only focus on the problematic halts, the ones which are triggered by illiquidity. And I repeat the tests, and results are robust. And then finally, what I do, I also add the straddle and the limit states, which are also events which delay trading. And I see that I have robust results. So basically, we see that practically here we have an externality from the equity markets to the derivative markets, which is facilitated by the halt mechanism that exists now in the circuit breakers. Okay. So I think I'm good with time. So in conclusion, circuit breakers have prevented market crashes from occurring during the pandemic. So they played a beneficial role in the market. However, while designed to accommodate informational shocks, most trading halts turned out to be liquidity events. They were followed by subsequent lower liquidity in all securities and by worse price discovery in smaller securities. And the channels for liquidity depletion were increased dark trading in large stock and increased use of ISO designated orders in small stocks, which also indicates market fragmentation during times of market stress. Also, circuit breakers facilitate the transmission of toxic equity volatility to the derivatives market. Toxic equity volatility refers to the transitory volatility. So I showed that illiquidity-driven halts in some of the S&P 500 constituents are associated with jumps in the spider. Now for the policy recommendations. So one refinement would be to redesign the price bands parameters based on securities volatilities. So basically right now they are price level specific. And we saw that they were binding, especially during the stress times when there is a lot more volatility in the market. So by redesigning the price bands, this may remove some of the halts, so may lead to a smaller number of halts in the market. Another recommendation is to design a longer duration limit state for tier 2 securities to avoid halts. So basically give more time to market makers to provide liquidity to the market. Now, of course, the possible concern may be that this change may worsen outcomes for news-driven halts, but however, it should be alleviated by the fact that most halts are actually illiquidity-driven. Another refinement will be to revisit the recent removal of double price bands at the open. So there is still a lot of information that comes during the night. So the problem with the previous double price bands were that they were suddenly dropped in half at 9:45, which led to a lot of halts. So what can be done here will be to downsize in smaller increments the bands to such that market makers will have time to adjust their costs and lead to a smaller number of halts. Also, regulators need to keep a close watch on the levels of dark trading and ISO used during times of market stress. And there is need for a better coordination between the spot and the derivatives market. Thank you very much. Any more questions?
Thank you, Claudia. Well, I actually have a question for your treatment and control security, particularly for smaller stocks. So I understand that control are the ones that did not enter the halt, right? They entered the limit state. Is there any other difference? Like, do they just reprice more frequently in those stocks to begin with? And this is kind of concerning also your recommendation about the longer duration. Like, is there anything else that it's just the ones that enter the halt is just that were maybe traded by humans and humans didn't pay attention, or are they all like sufficiently frequently replenished under regular circumstances?
That's a very, very good question, Katya. I will have to look more into these securities. That's an excellent question.
Jim, please.
Oh, I thank you. First of all, I want to thank you for an excellent paper and for bringing attention to this very important area. There's a lot that can be done to improve our limit up, limit down system. But I also want to point out that there is a regulatory problem in that trading in markets at the SEC has historically been incredibly slow in approving any kind of changes to limit up, limit down. And I know many people in the industry are extremely frustrated with seemingly innocuous changes, like wanting to move some tier 2 stocks to tier 1 that get rejected for seemingly no reason at all by our Securities and Exchange Commission. So hopefully the new regime will have a better approach to this. But yeah, there's a lot of work that needs to be done, and yet there are a lot of regulatory impediments to actually getting it done. So thank you for, again, bringing attention to the fact that we can do a better job. Personally, what I'd like to see is, instead of a halt, actually just have gradually widening bands. So it becomes almost a Walrasian tâtonnement when you have one of these dislocations. But again, there's plenty of room for further work.
Which would be, thank you so much, Jimmy. You're very kind. So that may be related to having band parameters based on securities volatilities. So more volatile times allow more price moves. Thank you. Thank you very much.
Yeah, actually, the Japanese markets have that kind of widening of the bands. So they do special quotes, and if nobody comes through, they double the band, and then they quadruple it, and so on. I think that design works quite well as well.
I'm sorry.
Well,
I stopped sharing. Thank you.
I saw Joel had his hand up before the slide stopped sharing. Joel, please.
That's okay. Thank you, Katya. So during this time, there was a study by an economist out of IEX, Benjamin Connaught, and he looked at the price formation during, now it was not limit up, limit down, it was the market-wide circuit breakers, but he noticed that if you were a subscriber to, say, the New York Stock Exchange, you would receive an awful lot of information about the reopening process that was not communicated on the consolidated quote or the consolidated trade tape. And do you know, does the same issue, and Benjamin was quite critical of that and thought there should be more transparency here as a regulatory issue. Do you know how this information is handled during reopenings from LULD halts?
Well, orders are accumulated during the halt, but the idea for the information to be disseminated to the whole market was behind the long 5-minute trading interruption. Now,
but this was just supposed to happen. I don't know. There, I don't want to say magically, but 5 minutes was supposed to be a presumptive time at the end of which everybody would know.
Yeah, so one could actually do a test by looking at the announcements, stock specific announcements, and check with the trading halts that occurred during that time. But as I found, most halts were not news driven, were illiquidity driven. So that can be a test actually to reinforce the fact that there were not many informational events coming during that time. That could be one thing that comes to mind. But that's a very very important point, Joel. And I honestly, yeah, it's a good question.
That's a good answer, but thank you.
Thank you, Joel. You're too kind.
Josh.
Hi, thanks, Claudia. So when you were going through the RDD methodology, it was going a little fast for me, and I kind of realized there was something I didn't quite catch. So maybe let me ask now. All right. So with RDD, usually there's like some continuous variable, and then you are comparing stuff just below the threshold to stuff just above the threshold. And I realized I didn't get, what is the continuous variable for you? And how do you tell if a stock was kind of like just barely over the threshold to get halted versus if it was farther over the threshold?
Well, being near the threshold is when the stock is in a limit or straddle. So basically, there is not enough liquidity in the market to have a crossing transaction. So that's the threshold. And after 15 seconds, the limit state can resolve in trading, or the stock can halt. So it's a trading process. Does trading continue or trading halts?
Yeah. So that, I think, if I understand right, this helps us see like kind of what was just under the threshold, like what just barely missed being halted.
Exactly. Yeah.
But then of the things that got halted, how do you tell what kind of like just barely did get halted versus what was not, what was farther away from the threshold in that direction?
Well, if it's in a limit state, you're with being in a limit state itself, you're thinking about okay, so these are the price bands, right? So you're here in the limit state. It doesn't matter where the other quote is, as you cannot have a transaction. The trading doesn't fall back between the price bands. Now, and I know what you are thinking in terms of like credit scores, and you are thinking about how far from a threshold. Maybe that's what you have in mind when you think about the RDD, right?
Yeah.
Yeah. So for me, the limit state is fixed, 15 seconds. You either continue trading or revert. So there is no how close you are. You see what I mean?
Okay.
You're in the
yeah,
limit
thanks.
state.
That helps.
Maybe I don't know, think about the volume that you have on that one leg, maybe a proxy. I don't know. I have to think about this. But it's fixed. It's exactly 15 seconds. Now, on the other hand, you have the stocks that continue trading. So they exit the limit state or the straddle state. And these are the ones that don't get treated.
Yeah, in a sense, I had a
thank
kind
you.
of
Thank you.
a similar question. So I couldn't formulate it properly, but it's when I'm asking like how different are the ones that got halted, I think that's actually what my question is, because if some of them I just get halted just because they very rarely trade, they're so far away from the threshold. That I think that so I had this kind of, my question has a similar flavor to it, but I just couldn't formulate it properly. Thank you, Josh.
I see. Yeah. Also, when in the robustness test, so I only use the for the treated ones, only the ones with the illiquidity driven halts. So in both for treated and non-treated, the gap in liquidity is the cause. So in this regard, they are very similar. You see what I mean, Josh? Now I can go and report some statistics as for how much volume there is in that specific security. Right now I have an average, a cross-section average. So I can go at the stock level and look at some statistics as well to see how close they are as well. But I also do the test by tier groups. So you have the large securities. So in this regard, they are very similar. Small securities, it's a different test. Also going to Katya's point. So small securities, so some of them exactly, they don't trade for a while. There is a lack of liquidity in them to start with. Yeah. Thank you. This also clarifies for me the setup. I appreciate the questions.
Yeah. Thank you.
Jose?
Hello, can you hear me?
I'm gonna stay.
Yes.
I don't know how to raise my hand in my
Oh,
system.
sorry, Chester.
That's
I saw your
okay.
comment in the chat, but I saw the raised hand. So while we're here, Claudia has agreed to stay for a little bit longer, so we're happy to stay. Just to remind everyone that this was the last session of the spring. We thank you all for attending and contributing. And once again, the reminder is that the call for papers are out. The link is in the chat. So now we're back to questions and comments.
So I put a comment in the chat. I thought Joel raised a very interesting point about the information that the listing exchange has isn't porting over to the other markets. It seems to me that's really highlighting a big advantage. So the listing exchange tends to have an advantage. They run the official open in general, so they have a big advantage at the open, and also, and I think also at the close, because they're the only ones doing those. But in some ways, I find it sort of too bad that advantage is now is extending to when there are these closures. That's kind of another reason why I think I'm not very happy that there's closures, because I do think competition across the listing business I see is sort of separate, and concerns about how that flows into the competition in the trading process, and I see this as potentially, depending upon how the exchanges use the information. I also see this as heightening the import for the value of proprietary data at the big listing exchanges, because it's, frankly, the proprietary data, so in the past, at least, Ben Canole was associated, I don't know if he still is, with the IEX. And obviously the proprietary data at the NYSE and the NASDAQ is sort of far more valuable. And there's been a lot of debate about whether there's too much monopoly power associated with the value of the proprietary data. So I see sort of all these issues as potentially tied in. And I think Joel was really highlighting a very interesting point with a lot of broad implications.
Oh yes, absolutely, absolutely.
Anyway, that's all I wanted to say.
Thank you very much, Chester.
Great.
Yes,
Back to Jose, sorry.
Okay. Can you hear me?
Yes.
Okay. So going back to Josh's point, I think we had this issue when we were trying to analyze the 201 stops, or the triggering of the 201s. And we went the way of creating a pseudo trigger event. And we got some very interesting results with that, or at least interesting to us. It's actually with the referees now somewhere.
Jose, can you share that with me, please? Can you share your work with me?
Yes, it's in SSRN. I'll send you the link.
Wonderful.
And, yeah, so maybe it's something that might be useful. So
absolutely. Thank you so much.
Because it's a trigger, it's triggered by the price, right? And yours says it's a similar thing, right? And the triggering event is itself an event. So the ones who were just before it and didn't trigger it had a very different experience. One, the price went up, or in our case, the price went down, continued going down, while the other one rebounded. So it's actually, we use a pseudo trigger defined prior to that, and compare the two. And actually, the comparison empirically looks to be a valid comparison with the pseudo trigger for the control. So you might want to look into that.
Excellent. Yes, I can include more about those checks. Wonderful. Thank you so much, Jose.
Albert?
Hi, Claudia. Thanks for the interesting and engaging talk on an important topic. One thing, while you were running through your results, that I kept asking was, where do you come out when you have all these results and think about it as an economist? It seems like you're saying, since these were illiquidity events mostly, that the circuit breakers are good. So they're a good thing to have in the market. But I wonder what your thoughts are. One could also say that at times where the markets get halted, are times where those who still provide liquidity, they're getting a good return on their services, because they get to trade it to them at advantageous prices. But if you stop the market, then you might actually affect the incentives of this type of people. They might actually lead the market, and liquidity could be worse overall. On the other hand, you could say you stop the market, and that in and of itself creates some visibility for people like, hey, there's a stock here that experiences illiquidity issues. please come and help out and take some of the other side of this trade. So anyways, I'm wondering what are your thoughts about whether this is good or bad in the end as an economist?
Yeah, so of course there are pros and cons. Here is what I'm debating is the specific mechanism. So in itself, there is a good idea to protect the markets from a flash crash, of course. Now, how we design the mechanism is that question here, and what can be done to remove all this delayed trading, so this large number of HUDs. While you were talking, I thought about so basically you can think about doing an exercise where you can look at the people's behavior. So practically having these HUDs triggers people's attention on specific securities. That would be interesting to do. But at the end of the day, so we have to look at the benefits and the cost of having the circuit breakers in place. And there are obvious benefits, but we have to also look at the cost. Are the costs too high to have the current mechanism still in place? And this is what I'm debating here.
Okay, thank you.
Any other questions, comments? I don't see any other questions. So thank you once again. Thank you very much, Claudia. That was very interesting.
Thank you
all for
so
coming.
much.
Have a nice summer, everyone. I may or may not see you over the summer, but we'll hope to see you back in September.
Thank you so much to all of you. Thank you for taking the time to attend the seminar and the feedback. You're very kind. I greatly appreciate it.
Thank you. Bye.